Hello and welcome to Chapter 4, Cash Flow Statements. So this chapter is a brief introduction to accounting and pretty much aims to show you basic concepts when reporting cash flow statements. The key idea is basically figuring out how much money do you have in your pocket at the end of each year, taking into account the accounting profits. That is the simple concept of profits equal to revenues minus costs, but also taking into consideration accounting artifacts such as non-cash expenses. So what are those non-cash expenses? Non-cash expenses, let's use the example of depreciation, are basically an accounting procedure that is allowed by the Internal Revenue Service, the IRS. What the government does is allow you to allocate that amount of investment across several years depending on the expected life of the asset. So certain assets are expected to last longer than others. So those with a longer expected life will see their amount of investment spread across more years. Whereas those with a shorter period of life, their amount of investment will be allocated across a smaller number of years. Now, who dictates this expected life of the asset? Pretty much the tables from the IRS. They categorize different assets in different families of assets, and they impose this number of years that you're going to be allowed to depreciate your asset. What I just described, we're going to look at it into more detail, and specifically at US rules in Chapter 5. However, in these cash flow statements that we're looking at in Chapter 4, it already shows up the depreciation and other non-cash expenses. So in summary, non-cash expenses are basically an inflated amount of costs that allows you to declare less profits and therefore pay a lower amount of taxes. So here on page 51, the key rationale is described. So items that show up in the cash flows, revenues, and the revenues are pretty much equal to number of units sold times the price per unit. Note that some wording is indented, meaning that they belong to that prior category. Is a typical procedure in accounting reporting, right? The main categories and then the level of indenting basically is indicating subcategories of that category. So we have revenues, which is basically equal to gross income, price times quantity, the same is to say sales. We oversimplifying, of course. This is just assuming that you only have one source of income, and that is the sale of goods. Then, from the revenues, you take out the costs. And there are the cash costs and non-cash costs that I mentioned. But the cash costs can be direct and indirect. Direct meaning that they are directly related with the production process and therefore proportional to the quantity of goods produced. And indirectly does not necessarily mean proportional, because it's like overhead, the administrative expenses. They tend to go up with the production levels, but not necessarily proportionally. So when you do revenues minus costs, these are basically profits before taxes, what we call net operating income. Okay, revenues minus costs. Then from that, we're going to take out the non-cash expenses, okay, allowable tax deductions. And when you do the revenues minus the cash costs minus the non-cash costs, you get the income before taxes, also known as EBIT, earnings before interest and tax. Then, to find out how much money you have in your pocket, right, you need to pay taxes. So from that amount, we deduct the amount of taxes. What we end up with is income after taxes. But this is not yet the amount of money we have in our pocket. To figure out how much money we have to bring back the non-cash charges. After all, like the name says, this was money that was not spent mandatorily this year. We could have bought a truck 3 years ago and we're still deducting it. The money was spent 3 years ago, but in the accounting procedure 3 years later still allows you to declare part of that cost as a non-cash expense, the depreciation example. So that cost was used to inflate costs so that we pay less taxes, but actually we didn't spend it this year. So to figure out how much money we have in our pocket, we need to add the non-cash expenses to the income after taxes, and then take out any other capital investments we did this given year. Okay? This is all calculated per year. You could go to granular detail as per quarter as well, but typically is per year. Then we take out the capital expenditures, as we just said, and then other items that could be added or subtracted, such as working capital, after-tax gains and losses from investments, and so on. Once you do all these computations, then you arrive at the net cash flow. This net cash flow takes into consideration all the above items, such as revenues, costs, taxes, non-cash expenses of different kinds, investments made in a given year, to figure out how much money is actually in our pocket, our net cash flow. And this was the item that we were using in our timeline. So all those numbers that we were making simulations with in our timelines, they were all net cash flows per year. And the procedure to get to that number is now here explained in granular detail. So let's look at an example. You're going to notice that the chapter is short because it's just basically exposing you to this algebra procedure. And for example number 2 on page 53, it's showing you an investment of 5 years. And what he's saying is in the first year there was nothing going on except for the investment. So we have equipment purchase at $250. So our net cash flow from that year was that amount of investment. We didn't pay taxes, we didn't do anything else except investing. $250, that will be our cash flow at times zero. Times zero. I just wrote it here again, times 0. Then, second year. This is today, right? Then at the end of the first year, year 1 in our timeline, we're still recording, no activity except for buying more equipment, additional $750. So the business just actually starts producing something by the end of year 2. And it says here, production units, 150 units, which were sold at an average price of $10 per unit. So our gross revenue was $1,500. Then, going to the costs category, cash costs, direct, examples, labor, supplies, miscellaneous. This is per unit, the way it's described here. You don't need to describe it per unit all the time, but it's described per unit here, which is useful information when we're looking how competitive a company is. So it says here that per unit we sold each unit at 10, but it cost us $4.80 in labor, $1.60 in supplies, another $1.60 in miscellaneous items. Adding these costs of $4.80 with $1.60 plus $1.60, so we're talking about $8, times the 150 units produced, we have costs of goods sold, $1,200. Then we bring the indirect costs, administrative, the lease, miscellaneous. So $21 total, this is not per unit now, $21 total, $53 total, $70 total. So you may think of these as millions if you want. I'm reading it as dollars. So we're talking about the indirect costs, administrative of $21, $53 for the lease, $70 for miscellaneous. Then we also take out the non-cash expenses, $133, a portion of those 1,000 invested. Another interesting thing is that you can only start taking depreciation once the machine, the equipment, is actually part of your production process and in operation. Till then, you cannot record depreciation if you're not using it. So adding the direct costs with the indirect costs and the non-cash costs, you get the total costs of $1,487 for this given year, meaning that revenues of $1,500 minus costs of $1,487, you have $13 of taxable income. Let's say that the tax rate is 40%, right? Then you would pay 5.2 in taxes, leaving you with an income after taxes of 7.80. But this is not your net cash flow yet. So to figure out how much money you actually have in your pocket, we bring that after-tax income, add up the money that we actually did not spend that year, the depreciation, the non-cash expense of 143, adding these two because there was nothing else going on, then gives us a net cash flow for the year of 150.80. So that will be our cash flow at time 2. Then you follow a similar rationale for the upcoming years, and you get a net cash flow of 366.80 for year 3, 513.40 for year 4, 535.60 for year 5, and this will be our timeline. And then what the textbook is saying is, okay, let's assume that your minimum acceptable rate of return was 15%. What is the net present value of this investment? So you would discount all these cash flows to times 0. That's what they do in year 1 by 1, computing how much is the cash flow at time 5 worth at time 0. So the 535 at time 0 would be worth at 266. The 519 at time 4 at time 0 would be worth at 296. And so on, and then add them up, and this gives a net present value of 16.28. Positive, thus meaning that this project generates more than the minimum acceptable rate of return. How much more? Since this is an absolute value method, $16.28. So $16.28 above the minimum 15% return required. So this will be an acceptable project. I suggest you do replicate this process with exercise number 1, which is for a single year, finding the net cash flow for year 93, and for exercise 2 on page 55 as well. This is 5 years of it, so therefore a more lengthy computation, good for practice, but these are very straightforward. Just refer to the table to basically fill out the spaces. And as you can see, this is a very short chapter, about 4 pages of length. The key idea again portrayed on page 51, basically revenues minus costs, where inside the costs there's the tricky issue of non-cash expenses, and they are used to inflate your costs in order to pay fewer taxes. But then when computing the net cash flow that year, you actually need to bring that money back because you didn't spend it. So that's it for chapter 4.